Hi, this is Fuquan Bilal, NNG Capital Fund, and I'm here today with the Rental Property Owners Association, and we're talking about my journey from the note business to doing some fix and flips and also managing a portfolio of rental properties.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 503. It's one thing to flip a house. It's another to raise $50 million and scale a portfolio across multiple markets while building lasting investor relationships. Fuquan Bilal has been in the real estate game for 25 years, focusing on distressed assets, Class B multifamily, and luxury single-family homes. As CEO of NNG Capital Fund, he's mastered the art of creative deal structures, capital raising, and long-term wealth building, all without chasing shiny objects or taking reckless risks. We're going to dig into how he approaches investor relationships, sources opportunity, and makes the numbers work in today's market. Fuquan, welcome to the show.
Thanks for having me, Brian. I really appreciate it.
Tell us a little bit about yourself. I mean, it seems like you're doing a lot of different types of investing, and you've been doing it for a long time. So I'd love to learn how you got started and kind of where you've been and where you're going.
I always say I jumped out the window and I grew wings falling down. That's what I always say. I've been on real estate since 99. I cut my teeth doing fix and flips before the GFC, the global financial crisis. Had a lot of success in learning the business, but did not have a lot of success in creating a real network, right? I didn't have any mentors. I wasn't a part of any masterminds. I wasn't a part of any real estate networks. It was just me and my team. And I thought I knew it all. And, I got my behind handed to me in 2008 GFC and pretty much had to start all over again. And as we were speaking before we started recording, where we met at a note conference, around 2010, I discovered the note business. I started investing some of my money, was able to create some real deal case studies, and decided, after I went over the hill and got the arrows in my back, so to speak, decided to open up an investment vehicle fund to raise capital to be able to scale that business. So our first fund was launched in 2013, primarily for the distressed debt business. During that time, a lot of the banks were dumping a lot of paper, if you will, over to us until, Dodd-Frank and a lot of the laws started to change later on. That made it difficult with all the regulations in place. So, we've made pivots over the years to adjust with the marketplace. We've done that probably over and over again and created a few funds up until 2017, 2019 was our last note fund. And we kind of transitioned into more rentals. I started investing in my own backyard locally where I did the flips with some rentals. And nobody, with all the relationships that I had from the banks, nobody wanted to buy judicial paper. So we were able to, get some of that paper, take it to foreclosure, create a lot of great relationships with REO banks who had REOs on their books before they kind of sold them to the real estate person. And then we started to scale that rental portfolio. And then we had COVID. And then after COVID, we decided to divest that portfolio and invest that money for rentals out of state, more the red states, where you can evict faster, because we had some challenges in New Jersey. People were saying they had COVID, they couldn't pay. So we wound up divesting that portfolio. It was very profitable because we had a lot of New Yorkers coming over, paying 30% of a list. So we were able to get out of those assets and invest more in the Southeast, which really falls in line with the main reason that we do what we do, is to create an impact. I come from a low income family. So growing up in those areas, C plus, properties in areas, it's kind of tough really to build traction if you don't really understand like how to go from a complex to community, right? It's not just changing the curb appeal of the property. You have to also try to change the mindset of the people who lives there. So it's been the journey. navigating through those different types of asset classes.
What were some of the deals you were doing in the note world from 2013 through 2017 and the type of returns you were able to get? And then what made you realize, hey, that party's ending?
It was some great returns, man. It was like unbelievable because we were buying debt at 10 cents on a dollar. And, to give a homeowner reprieve by sharing a discount with them was a good feeling, letting them keep the house and we just get the payments. And then taking that distress note, performing it or reperforming it, which is like rehabbing a note, right? And once they made 12 consistent payments, we were able to take the unpaid principal balance face value to market for sale and still sell it at a discount, which yielded the investor that purchased it a double-digit yield. And we made a great return on our money. What we used to do was buy pools of notes, and then we would take what I would call the creme de la creme, the all non-judicial high equity. We would put those out for sale to recapitalize on our spend, and we would keep what people deemed were the ugly notes, the ones that were underwater, Chapter 13 bankruptcy. And those became the most valuable because we used the weighted average approach when we did purchase notes, meaning that when you buy a pool, all of the money is allocated towards the high equity non-judicial. So we paid 6 cents on a dollar or 5 cents on a dollar for something that was negative equity, Chapter 13. We found that those had way more value and bigger profits. So we started to really roll our sleeves up and focus on that side of the business, looking for the ugly paper, if you will. And every time we got a trade, we were known for selling the highest quality out right away. And people were like, this is crazy. Like, why are you guys giving away the most valuable notes? Because we can easily recapitalize on our spend. Everybody was looking for that same product, which created a demand, which increased pricing. So that's the space that we played for a long time in the note business. Profits were unbelievable. I would tell investors that, I made, 2x, 3x return on the money, sometimes a 5x, right? If you purchased a note for $5,000 and you sold it later for, $25,000, $30,000, that was realistic.
Were you self-funding at the time? Were you raising money? Or how were you able to take down those notes?
At first, when I was learning the note business between 2010 and 2012, it was all self-funded. So it was monies that I had from real estate, whether if I sold the property or whatever, we rentals we didn't have, we started to buy notes. And we started in like the secondary space. We were buying second mortgages. The average UPB could be anywhere from, 20,000 to 150,000, somewhere around there. Just because you had to buy the whole tape. So again, even with the low balance UPBs, we would just offer settlements on those. If somebody owed 50,000, maybe that note cost us, 5,000 or whatever the case may be. We would just tell them, hey, if you give us 15,000, we'll eliminate the debt and still make a profit that way. So there were different types of collections that we did. But from 2010, before I opened the fund, it was self-funded. And then I said, I can scale this thing and take it to the next level. And then quickly learn that part of the note business, primarily second mortgages, is like a business, right? Because you have so many notes, you have so many workouts. So we started to focus on lower UPB first mortgages, like in Ohio and different states, Georgia, North Carolina, where we can get a senior lien. Price was a little bit more expensive, but what we learned with that is everything goes to foreclosure before you can work something out. So at the end, what I learned about the note business is the attorneys make all the money. So and pricing started to increase. So it was time to transition from that.
Prices started to increase. Why? I mean, in my experience, it's because everyone else was piling in to that world and bidding up the prices. Is that kind of what you
caught on very fast? As you and I were talking, we met at a note conference years ago. A lot of people would attend those note conferences and would diversify their strategy, whatever they were doing, and experiment a portion of their portfolio in the note business, whether they were passive or whether they would buy a few performers or they would buy notes and try to do it themselves with the servicer. So everyone was experimenting around that time. And I think that is what led to price increasing because the secret was out.
So was it a logical transition to move into the rehab world? And were you doing fix and flips, buy and hold? What exactly were you doing in that world?
Yeah, so both. I mean, that's where I came from. I got my start doing fix and flip. And I sold over 150 houses before the GFC had, came about. And having that experience, those relationships, and knowing the process of building a house. Before that, it was more of rehabs, just going in, updating kitchens and bathrooms, putting them back on the market. Then it slowly transitioned to gutting the entire house out to the beam, to today where we just tear the house down and build new or add an addition and bring a new product to the market. So it's just seeing where the market was going, right? I had those relationships that I created with banks. I had access to properties and started to add a little bit more diversity in the portfolio while we still maintain a note portfolio. And still today, we have, more than 10 million UPB of second mortgages that we just let the popcorn pop, right? There was a note in Hawaii that I've owned for like 4 years, and the person just paid off over 200 grand with interest and everything else. And this was a note that we paid like, I don't know, 60 something thousand for, but we had some legal fees. We were all into it, less than 70 grand. And we just got like a $238,000 payoff. I mean, it took 4 or 5 years, but the popcorn pops. So, and the good thing was that it just came out of nowhere, right? You get that, you'll pull a note out of the drawer and go, oh, remember this note? They want a payoff on it. So that's the part I like about the note business, but you can't control it, right? So it's a human on the other side. You have to figure out when they're ready to make a payment based on their financial situation. With the real estate, it's something that, you can build a process and control the timeline of construction once you get permits. And you can see the end goal. With notes is unknown. Like you don't know, unless you're doing foreclosure and taking a property and exiting that way, you really don't know like a foreseeable timeline to get back to the profit.
Now you've been doing the rehabs and the fix and flips for quite a while. What are some of the controls that you've put in place so that it's sort of systematized and works the way it should?
That's a consistent challenge. As you know, dealing with contractors, nothing is ever perfect. But some of the things that we put in place are standard operating procedures that we have for every single process of construction, from acquisition to demolition to permitting, dealing with the architect to design, creating PowerPoint presentations of what the product will look like, the fixtures that are inside of the property, light fixtures, mirrors, doors, doorknobs, hinges, everything, like in a presentation where you can create a detailed scope of work to get a request for proposals on. And then we put those scopes of work into QR codes, put them on the properties. So that kind of alleviates questions coming from contractors. Which way did you want the ceramic tile to be designed? They have it at the property, and then really hiring a really good project manager to make sure that the project goes as planned, which never happens. You're always going to go over budget and things are not going to go the way as planned. No, regardless, for me, my experience in this business for 26 years, you always have to make room for error, even from the architect drawings. The architect designs the property. Once they start framing, it's something completely different, and you have to be able to make those adjustments as you go along. So and those are some of the things that we had to put in place, which helps us speed up the process, right? That's what you want to be able to create processes to help you get to the build faster, to eliminate any lag on the different phases.
What does a team look like that you put together? I mean, who's doing what, and what positions go unfilled at this point?
So on the multifamily side, we just have asset management. We do have we do self-manage the properties, but we have property managers for the multifamilies that work at the property, but under our payroll, and we just asset manage it. And we rely on the qualified people we hire. Even with that, it's still a process. You always have to inspect what you expect. So I myself will fly down at least maybe twice a quarter to, inspect what I expect, to make sure the grounds are kept clean and everything is going right operationally, as well as our asset managers that assist with that. On the construction side, you need, good project managers, procurement officer, someone to make sure that the permits and everything is taken care of and filed properly, following up on those inspections. And then we have an investor relations department as well to make sure that the customer service with the investors, the communication, access to their portal, any financial documents, all of that stuff is taken care of. So our team consists of 12 people. Most of that is virtual to handle like the light administrative stuff, but that's kind of what we are today.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. It sounds like if you're flying to some of these properties, you're investing remotely. Where exactly are you doing your investing right now?
We're in Alabama and Middle Georgia right now. So we made a transition, as I said, after COVID to buy larger properties, anywhere from 40 to 150 units. And that allowed us to do the same impact that we were doing in here in New Jersey, where we would do quality, affordable housing for low income families. Instead of just lipstick on a pig, this is a Class C plus property or a Class B property. Let's just, do the minimum work and get the rents. Our goal is to provide quality, affordable housing for low income families.
How has multifamily been a shift for you? I mean, from the notes to the single family to multifamily, did you have to go and relearn how to invest in multifamily, or were you able to leverage a lot of the knowledge you already had from the other two worlds into what you were doing to help find success?
Multifamily is completely different, right? I thought by having X amount of years experience in real estate that, this is just, another asset. Is the same way as a 3-family or a 12-unit rental. But it's completely different in ways that unless you actually do it, you would never know, right? So example I would give you is developing a good strategy to build your CapEx team boots on the ground. So especially being an out of town investor, you will be taken advantage of as far as cost, pricing. They can smell you a mile away. This is the guy from up north. Let's get him. So really developing those boots on the ground relationships and of course, giving opportunities to the local vendors, but just making sure they have consistent work and volume where you can do, good price cutting. So here's an example. So if I'm turning units, right, let's say I have 5 units I need to turn. Instead of hiring one contractor to turn the entire unit, you have teams. You have your painting team, you have your punch team, you have your floor carpet team. So you're not giving the job out to one person and you get it done faster and in volume, right? So those are some of the things that I've learned along the way, because most property owners go, our maintenance people can do this quick turn. They can paint, or they can install this and install that, right? And then they have work orders backing up because they're trying to save money on having a maintenance guy do something where a painter can come in and paint 2-bedroom apartment in 2 days, right? So where it takes them a week. So learning how to have those things in place is something that we've implemented, that I've learned along the way. And that's made a great difference to help us get units ready faster, right? To avoid having a vacancy for a long time. Even with operational things like RUBS, implementing the racial utility billing service at most of your properties, where you can pass back those expenses for common area utilities or water or whatever it is back to the residents, to remove that off your expense and make that into something that the property is paying for, the residents is paying for. Just so many different things I can go on the list that you really have to be hands-on, because hiring a property management company, they're just going to check the box. We paid the bills, we did this, we did that. They don't really have an interest versus just trying to collect accrual fees that where it's not really cash collected and bill you that management fee based off accrued income. So there's a lot of different things you learn when you outsource versus, doing it yourself. It's a lot more work doing it yourself, but you'll save a lot more expenses and you'll learn more about the property faster. So, I mean, it was a learning curve for me for sure. There's things that I'm still learning, about that business.
Are you still acquiring multifamily or, I mean, and how do you find the market right now? I mean, are there properties that you're going after?
Well, there's great opportunities on a market. It just depends on like what your focus is. I would say for us, the focus is finding things that are already 90% or more occupied that may just need some improvements. And the reason why, so we can get permanent financing. And if we can't get permanent financing, it have to be a seller finance structure, which is some of the things that I learned in the note business. Creating a note where the seller becomes the bank and lend to your LLC for a short term with a fixed interest rate while you do the capital expenditures and get the property to stabilization so you can get permanent debt. So we will only look for opportunities that are distressed if the seller is willing to finance. And most of the time you will. You'll find there's people who've owned these assets in their family and they've been passed down the generations. And then the last person with it is tired of it. They don't want to deal with it. They're an absentee owner. So they're more susceptible to doing some type of owner finance structure if they can get a decent cash down payment because they know the property is not, it needs a bunch of renovations. It needs, things to happen and you can't get permanent financing. So once they're educated that it's a win-win for them, that way they don't have this big tax gain and they'll hold a note and they'll get something at the table, but they'll hold a note. It's a better deal for us to kind of take down with multifamily. So right now, what we're focusing on these first 2 quarters was operational efficiency with the current assets that we had. We have 2 projects that are under construction, multifamily. So we're focusing on finishing that. And probably somewhere around Q4, we'll be looking to take down more assets. It takes us around 6 to 7 months by the time we purchase the property to kind of really understand everything about the property, all the lies the seller told us when we were buying it, all the things you find out afterwards. It takes about 6 to 7 months to really get a handle on it and start to build traction. So yeah, we'll be looking for more acquisitions towards Q4. The market is great. I mean, it's a lot of blood in the street. Operators that had some challenges with the not having permanent debt. And when the market shifted in 2022, a lot of those guys are starting to fall apart. So yeah, there's plenty of opportunity that's out there.
As you take down these properties and you're also doing some development, it sounds like, where are you coming up with the equity to do that? Are you raising money from investors? I mean, how do you structure these deals?
We have a mezz fund that we raise capital for. We would pay investors with that. And then basically they'll have priority over the other investors and they'll be lenders into that project. So that's kind of how we are currently raising capital for those assets. And then on the luxury spec homes that we do in New Jersey, we have another fund for that we raise capital for. And investors get a chance to participate with us on those. So yeah, we're steadily raising capital. You have to always be raising. It's something that I learned because, as you're going through a stabilization period or operational efficiency, whatever it is, I mean, there's always a deal out there, a great deal, not a good deal, that makes sense to take down if you can put all the pieces together.
With all the projects you have going on and the different businesses you have going on, how do you find time to communicate with investors and reach out to them, let them know what you're up to and raise money when the time comes?
We have 2 verticals that we're focusing on. Like I said, we're not doing pretty much nothing in the note space anywhere. We still have those assets that, again, if homeowners reach out from refinance or payoff, we'll exit those deals. What I've learned from that part of the business, the best exit strategy is through the homeowner. So we're not actively buying any more notes, but we're focused on 2 verticals, which are the luxury spec homes in New Jersey, and then also the multifamily in the Southeast. So our communication to our investors, at least once a month, we're giving them an update of where we are. I've found that over the years, communication is very, very important, whether it's good, bad, or ugly. You want to communicate to the investor what's happening, what challenges you're having, what goals that you have for the quarter, what did you end up with that? So this constant communication, and they love it, whether it's just a text message from me, hey, just checking in on you to see how you're doing. Just wanted to reach out. We just actually sent out statements today to investors. So, they get that email once a quarter, the statements are out, and it's a follow-up text from me if they have any questions. So just constant communication and updates I found to be very helpful and important because you continue to educate the investor too on what's happening with the market, with the industry. specific to your area, right? Because some things that are macro in the headlines may not affect what's in the micro, right? What's happening in your market. Like, so for example, North Jersey is on fire with residential properties, right? Because we're close to New York. We still have the houses that are selling north of 2 million, between 2 to 2.5 million. They're selling more than the houses that are 400,000 and below. So, it's a strong market in North Jersey, and we like to keep investors updated on what's happening, since that's primarily what we focused on in investing in luxury spec homes.
Are you using any particular software or systems that you can mention that help you communicate with investors, keep track of their investments, and send out those statements?
We use AppFolio. AppFolio, there's a bunch of them out there, but we like AppFolio. That's what we're using for our back office, for investors to log into their portal, get their statements, communications. It actually ties into our property management software, because we use AppFolio for that. There's a software called Alpha, and you can actually pull data from like rent roll and everything else and put that into an email on the investor relations side to your investors. So it pulls real-time information from your property management, because it's the same software, and it helps put it into a report that you can send out to investors on where you are with cash flow or expenses, anything.
And how are you sourcing your deals? I heard you mention you're doing seller financing. Are you finding these off market or working through brokers?
Both, actually. Creating those relationships with brokers and performing, you always get a deal before it hit the market. As a matter of fact, I was on a call around 9 o'clock this morning with a broker who actually had some stuff in Birmingham that he was actually finalizing the pro forma. And he was like, hey, before I put on the market, we won't be done with this until the end of the week. We needed to go through like quality control. Here's a deal that I have. Let me know before I go ahead and list it. So we always get opportunities like that sent to us. You have to kiss a lot of frogs. You have to really find, like I said, a great deal. That's kind of what I'm in the market for now. Great deals. Good deals are okay, but great deals are the ones that stand out, that really makes sense to execute on.
Describe what you would consider a great deal in this market right now, and how you would make those numbers pencil out.
So something that you can assume financing, that already have fixed debt in place, and you just have to come up with the rest of the equity. And in most cases, you can make the seller partner in the deal. So the deal structure is what makes it a great deal, right? Everything comes in the way you structure the deal. It doesn't have to be the price, because you can buy on terms. You can buy at the price they have, but you can structure the terms where it becomes a great deal for you. An example of seller financing, right? Where I can get a seller to take 6% interest only for 3 years. I'll give them a couple $100,000 down for down payment, and they become the lender. Or assuming the loan and then still making the seller GP in the deal and giving them a cut as well. So those type of deals where you can get in for little to nothing and have control over the deal with favorable rates, to me, that's a great deal.
How would our listeners find out more about you or get a hold of you?
You can go to NNGCapitalFund.com. You can also go to Invest Clearly. That's another platform. It's like the Google of sponsors. You can go there, check out other opportunities. We're there as well. Investors that are investing with you can leave testimonials. It's a good way for you to vet sponsors. So you can find me there as well as social media.
What is your favorite hack or app?
ChatGPT. I learned this 3 years ago. And it's funny because I introduced my kids to it. And I use it for pretty much everything, even legal work. I'll prompt it and ask questions and then send it to my attorney. It's like, hey, is this right? I'll be like, well, yeah. So, you get so many different things. That's my favorite app that I'm currently using right now. I mean, there's a bunch of other ones, but we use this. For example, when I go to conferences, there's things that you can record and then it will summarize it. It will email the person. There's so many different things that you can do from it. So that's my favorite one because I've been using it for so long.
Have you figured out how to integrate it into your property management?
No, we actually have a AI software called, there's a bunch of them in AppFolio. They have Lisa, they have RealmX, which is AI within the software. And that will do lease renewals automatically. It will do collection follow-ups automatically. When tenants are trying to lease units, it would text them, schedule appointments. It does it all. So it's something that we recently implemented just last quarter, the AI that the system has. So we have a CRM that already has an AI, right? We'll just tap into that and leverage that instead of trying to build something new, right?
How's that working for you? Have you found that it's pretty seamless, or have you had any issues?
For sure. We actually implemented Lisa. We had a lot of success, increase our appointments, right? And basically now we're trying to work out appointments to application, the application to move in. So it basically allows us to figure out where we're weak at, if we need to do more marketing or if we need to do more for conversion with follow-ups. So it gives us the breakdown of where we're weak at and help us really manage and drill down into those KPIs. So yeah, we love it. And now it's also, they have Realm X, which allows you to have automatic lease renewals sent to tenants, follows on collections, and it does a lot of the mundane processes that your staff would normally do manually, where you could just log into the system and go, oh, it contacted this group of tenants on this day for that. And that's pretty cool.
Fuquan, thanks so much for coming on the show today and just sharing your experience and knowledge with us, from the note world to the fix and flip and rehab world to the multifamily world. I mean, you really have shared a lot of expertise in all of those areas with us. I appreciate you having this conversation with us, and thank you so much.
Absolutely. And I just want to tell the listeners that it's been a 26-year journey for me. And you want to create mastery in something before you move to the next, right? You don't want to be a mile wide and an inch deep. As the saying, the man who chases two rabbits catches none. So you want to make sure that you have your systems, processes in place before you move on to something else. That's one thing that I learned. That you'll spread yourself too thin and you won't have success with anything.
Great advice. Thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com.
And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.